Good morning. I'm Gord Long with the Financial Repression Authority. I have Ronnie Lapinsky Sachs joining us this morning. Ronnie is Senior Portfolio Management Director and Senior Vice President Financial Advisory at Morgan Stanley. Welcome, Ronnie.
Hi, how are you? Thank you.
I really appreciate you joining us here this morning. I think we got some interesting discussions, especially with having the Fed announcement this week. But before we get into that, maybe we can begin with you giving us, our listeners, just a brief outline of your background and your current involvements.
Certainly. I consider myself one of the most fortunate, the fortunate ones. I honestly took a job when I was 21 years old. It was 1976. I was hired at E.F. Hutton & Company, and I have never left that firm. I have basically only had one position all these years, and come this May, I'll be looking at 40 years of managing money for the wealthy. So from what I understand, especially with today's millennials changing jobs so often, having been with one company all the way through, it's pretty unusual.
Well, I think we're the same generation then, because I go back 40 years but with a couple corporations in my period. Ronnie, I mentioned about the Fed here as we were starting. Can you talk about the Federal Reserve's, what they've done, their policy, their interest rate direction in terms of what you see is happening and going to happen, and how it will affect the financial markets, obviously?
Well, clearly, as most of us already know, markets like clarity. And Janet Yellen delivered a very clear, very explicit, and very specific commentary to her non-surprise raise of 1/4 point. She was also clear that she'll remain accommodative. They're going to monitor the data. They're going to look at GDP. They're going to look at inflation, and they're going to be data dependent. I don't think that this is a surprise. Morgan Stanley's Global Investment Committee supports that this type of rate normalization is absolutely, that premise is going to be a headwind for investors that use bonds for principal preservation. And said another way, any client or any investor that has a long-term bond portfolio should expect a decline in principal should interest rates continue to rise. We can see mathematically, bond markets don't always trade on emotions. Bond markets are very mathematical according to rates and comparative rates and credit spreads. So we should be prepared. If the Fed is going to raise one full percentage point, we can see as much as a 17 to 18% decline in the principal of a long-term bond portfolio. So that is one of the most tremendous impacts that advisors and investors need to know. And they really need to understand that so that they know how to invest their money, not only now, but going forward.
That's a real hit if that happens. If it follows through and we don't see a recession and force the Fed to change direction or whatever, but everybody needs to be fully cognizant of that potential.
Absolutely. And how many years do we talk about laddered portfolios and changes and evolutions in markets and interest rates? We can talk about this, but the application is not always that easy. Also, of course, there are other things that come into play. Right now, companies have strong balance sheets, and we like the companies that have the strongest of the balance sheets, provided that they don't have a lot of floating rate debt. That's just another point of common sense. If you have loans out and rates change and they go higher, your interest expense is going to go up and your coverage is going to change. So we look to companies that have balance sheets that are a lot cleaner. Of course, another thing that I can mention most importantly is that this is all good for the middle class. It's really important to note that we see this tightening as a signal of self-sustainability. It's not the end of an economic expansion, as rate hikes have been in the past. The Fed will continue to rise rates. This is good news. I take this as a confirmation of what seemingly is a good economy. Right now, it's good for the middle class. We have good consumer confidence numbers coming from the data out of Michigan, and we see consumer spending doing well. We see the middle class doing well. It would come as no surprise that in terms of sector selection, we look at things that consumers invest in, housing, middle to lower tier retail, the airlines, leisure, things where consumer confidence has been boosted.
Ronnie, I think the middle class in America really does need a shot in the arm, because I think and savers have been feeling it pretty strongly here, retirement people, for a number of years.
Right, and there's no question, moving forward in this conversation, that the consequence has been problematic to create income from accounts, and that is not changing anytime soon. This quarter of a rate hike is going to have very little effect at the moment, although we do keep our ears and eyes open for what's ahead of us.
Ronnie, what are the challenges with portfolio management for clients in today's environment, resulting from this long period of 0%, or even the potential of NIRP, or negative interest rates?
Well, I think that, look, there are all kinds of risks out there. We're talking about interest rate risks, but the distant cousin, of course, is credit risk. There are headline risks. There's geopolitical risks. We can create a very, very long line.
And we have them all right now, don't we? Every one of them.
Some people think so, but maybe at the end of this conversation I can tie up with a positive outlook towards innovation and other things that I see. But definitely there is a real challenge and a real choice. There's a real choice about how we invest our monies and how advisors offer up that advice. And that choice has to be understanding and cognizant that the credit quality risk is now more important in many ways than any other factor that we look at.
We've had guests on before, and they've expressed concerns about lack of price discovery, malinvestment, improper pricing of risk. But what do you see in terms of unintended asset price distortions right now, resulting from this period?
The credit spreads are large. They're clear. You're rewarded. The income that you get for the safer security is less than the credit quality that the income that you get for higher. Having said that, we just saw Third Avenue, a big problem in the high yield credit market. These things are very risky. In my world, I have a business that is much more moderate. I have very little in terms of very aggressive allocations. Mm-hmm. So I believe that moderation in most things. And so,
well, I think a lot of people would agree very much now, because there's a lot of people hurting right now in the high yield junk bond market, and at least temporarily feeling some pretty significant pain.
Well, let's be clear for a minute and go back in terms of my business. I am very much a retail wealth advisor. Mm-hmm. I deal with retail. I deal with individual stocks and bonds and ETFs and managers in the retail world. I work directly with families, helping them to achieve their goals. Every day we're challenged by this economic environment, but having said that, if clients would focus on their allocations and on their risk levels, that would be the very best advice that I could offer. That you must stick to your allocation, and as markets evolve and as markets change, those allocations are going to change, and you must be true to the allocation.
Mm-hmm. In that regard, then, what types of generic investment classes, investment approaches make sense to you right now, and that you're recommending?
Well, again, we're looking at things that benefit the consumer, but over and above that, here in the U.S., we look at technology, we're looking at the financials, we're looking at consumer housing and related products. And in fixed income, I believe in a fixed income allocation as long as you keep your durations short, or shorter than you would normally.
Can you make any comments on managing risk today for your clients, and what kinds of things must they be front and center on in thinking about how to manage and judge risk? And I'm not talking about portfolio allocation just here.
Well, I think we need to be honest with ourselves, like we are in our doctor's offices and in most other places. Money is one of the most intimate things that we can really talk about and we can identify ourselves with. Who's to say that we shouldn't all be better self-actualized, et cetera. But having said that, we need to be honest about our needs, whether or not we can risk any part of our savings, and to what extent the reward of the income that we receive is in sync with our financial needs. It's certainly a conundrum.
Mm-hmm. Everybody that's been on have grappled and have explained to us in various degrees what they grapple with every day in trying to manage all the various types of risk. And one of the ways that a lot of people have been talking about for quite some time is international geographical diversification, so that you can remove some of this degree of risk. How do you factor that into the investment process, or do you?
I think. Oh, I absolutely do. I think having an allocation internationally is very important. In the past several years, I have had less of an allocation, but today we look at Japan, which has certainly gone through a rebalancing stage, and we think that there's opportunity in Japan. We're looking at the European countries getting support from the ECB with quantitative easing. It puts a similarity back to where the United States was a few years ago, and we look for European equities to continue to do well. So we do think that there's a place for international exposure.
Ronnie, with your 40 years of experience, and in today's environment, are there some misguided perceptions that you see from investors in making their decisions that you have to advise them on and try and change their views on it?
Misguided perceptions. Well, we've learned so much about misguided perceptions that Americans thought housing, wasn't there a quote that Americans or people thought that their real estate properties could never go lower, or
Exactly.
that markets could,
Exactly.
and all in all, we have had so many lessons in the last several years. Preservation of capital becomes paramount. It certainly becomes paramount when I'm talking to a client about their portfolios. We really have to advise. We want to protect the base. We want to protect the capital, and we want to provide the right growth and income commensurate with the risk. That's what this is all about. I believe that if clients can really watch their allocations, and advisors can really watch the value of the dollar and how that impacts all of what we do, there's an opportunity there to develop, a portfolio strategy that makes sense. When I look out into the world, let's take a step back. When I look at what I want to invest in or how I want to invest, given all the headwinds that we see and we talk about, I still see a combination of innovation. I see big data combined with technology, big data combined with medical advances. The world is going to continue. It's going to change. Opportunities will continue to abound. These are the things that we look for in the markets. These are the things that we look to invest in. And if we can do that, circling back to my original thought, where clients and advisors watch their allocations and we watch the economics behind them with the value of the dollar right now, I think that's what sets up for a good program.
You've mentioned the dollar, the U.S. dollar, a couple times. Concerns or thinking in regards to the dollar and in portfolio allocation and management?
Well, I think that the ups and downs of the value of the dollar get a little bit more sophisticated than not. It's a function of currencies. It's a function of exchange. It's a function of the FOMC raising or not. GDP growth, the function of the dollar is intertwined with so many things today that I'm not sure that I have answered your question. But
it's had dramatic impact on emerging markets and some of those investments and the problems they've been facing with such a strength in the U.S. dollar, and I would venture to say the carry trade to the emerging markets. But now I think, and I don't know if I stand to be corrected, but I'm starting to see it flow through to earnings because of a strong dollar, repatriating it back, and pressures on earnings. And we've had a couple quarters now where earnings have not been growing at the same rate. Are you seeing the same thing?
Absolutely. I couldn't agree with you more.
And what's troubling to us is we don't see the top line growth. Generally across the board, there are some stars, and there's you got to find those. But top line growth hasn't been there. We don't see the capital investment being made. Are you seeing any corporate trends in terms of the S&P 500 that are noticeable to you? Where they're investing their capital, how they're doing buybacks to the extent money that they're borrowing for dividends?
I do see. We continue to see tremendous cash balances in many of our growth stocks. We believe we will see further consolidations. We will see further dividend hikes. We will see additional buyback of individual shares. We see all of those things, yes.
Continuing.
Yes.
Because we've noticed some of the corporations now they've borrowed. I'm thinking of IBM as I'm saying that have borrowed extensively because money's been cheap and have used the money for buybacks and lesser degree dividends. But now all of a sudden they're facing the amount of credit, the debt that they have accumulated, which could jeopardize their credit rating. So I'm wondering whether buybacks can sustain their current momentum that we've seen across the S&P.
Well, I think so, but
okay.
I have no data at the moment to support that, to tell you the truth. I mean, in terms of
what I'm thinking, where I'm coming from, that experience, not just seeing those things, we're seeing this. It looks like a shift in the credit cycle, and specifically, we start looking at the junk bonds we talked about earlier, investment grade. The pressures, at least on the short term, are there. And if there is a shift in the credit cycle, those will have eventually some impact on the buybacks. Oh, I think.
Mm-hmm. Well, you possibly could be correct.
Okay. Ronnie, are there any key messages that you'd like to leave with our investors here this morning?
Surely we continue to think in a combination of ways that the lower energy prices will continue to drive consumer spending, even if we have questionable growth, as you suggest. We are confirmed even more recently that there are lower unemployment levels, and we have plenty of data now to support a stronger wage growth. So again, we are looking at the middle class and strength in the middle class and spending of the middle class. We see consumer confidence at an 8-year high based on the University of Michigan Consumer Sentiment Index, et cetera. So again, in terms of sectors, we are looking at those that would benefit the middle class. And again, not to be too repetitive, I believe that if we continue to watch our allocations and we continue to look at the economics behind that and not get so set up with the day-to-day minutia, although important, we need to look at the outcomes. And we need to position our portfolios for the longer term rather than the day-to-day. That's what I do.
I think many people are guilty of too short-term, myopic views of things, and investing is about balance, judgment, managing risk, and longer-term views. And,
well said. Couldn't have said it better myself.
Oh, that's 40 years of my experience. But
you 40 years of mine, so we've got 80.
So that's what you have to do, and don't get too high, don't get too low, but stay focused. Stay focused on real value, real plans, and the rest usually takes care of itself eventually. Ronnie, we're up against our hard line here. Great discussion. How would our listeners learn more about what Morgan Stanley's portfolios, recommendations, how could they take advantage of what Morgan Stanley has to offer?
Well, Morgan Stanley has a very significant website at ms.com. I can be reached, of course, anyone can Google me, Ronnie Sachs, it's S-A-X, at Morgan Stanley. I haven't done it myself, but I'm sure that I'm easily findable. My email is r.lapinsky-sachs@morganstanley.com.
Ronnie, really appreciate the time this morning. Thank you very much, and the best of the holiday period for you.
You too. Thank you.
Talk to you again. Bye-bye.